Equity stripping, an in-depth exploration. Equity stripping is a financial strategy that involves reducing or stripping the equity from an asset, typically real estate, through various means. This concept is multifaceted, with applications ranging from legitimate financial planning to predatory lending practices. Understanding the nuances of equity stripping is crucial for homeowners, investors, and financial professionals, as the implications can significantly impact financial stability and legal standing. Understanding equity and its importance. Before diving into equity stripping, it is essential to understand what equity represents in the context of real estate. Equity is the difference between the current market value of a property and the amount owed on any mortgages or liens against it. For example, if a home is worth $300,000 and the homeowner owes $200,000 on their mortgage, the equity in the property is $100,000. Equity represents the homeowner's stake in the property and is a crucial component of their net worth. Equity is valuable because it can be leveraged for various financial purposes, such as obtaining loans, financing home improvements, or securing retirement income. Homeowners often view their home equity as a significant part of their financial security, which is why equity stripping can be a contentious and impactful strategy. Legitimate uses of equity stripping. Equity stripping is not inherently negative. In fact, there are several legitimate reasons why individuals or businesses might choose to strip equity from a property. 1. Asset protection. One of the primary reasons for equity stripping is asset protection. In some cases, individuals may seek to reduce the equity in their property to make it less attractive to potential creditors. By taking out a home equity loan or a second mortgage, the homeowner can convert their home equity into cash, which can then be invested or used to pay off other debts. This strategy can be particularly useful for individuals facing lawsuits or those who work in professions with a high risk of litigation. By reducing the equity in their property, they lower the amount of wealth that creditors could potentially claim in a lawsuit. 2. Tax planning. Equity stripping can also be a tool for tax planning. For instance, businesses may reduce the equity in their assets to lower their taxable income. By borrowing against an asset and using the loan proceeds for business expenses, the interest payments on the loan may be tax-deductible, effectively reducing the company's tax liability. This strategy can also apply to individuals who use home equity loans for deductible expenses, such as home improvements. 3. Investment opportunities. Homeowners and investors might strip equity from a property to free up capital for other investments. For example, an investor might take out a loan against the equity in a rental property to finance the purchase of another property. This approach allows the investor to leverage existing assets to expand their portfolio and potentially increase their overall returns. Predatory equity stripping practices. While there are legitimate reasons to strip equity, the term equity stripping is often associated with predatory practices that exploit homeowners, particularly those in financial distress. These practices can lead to significant financial harm, including the loss of the home itself. 1. Predatory lending. Predatory equity stripping often occurs in the context of predatory lending. In these cases, a lender might encourage a homeowner to take on additional debt against their property, typically through high-interest loans or refinancing options that the homeowner cannot realistically afford. The lender may target homeowners with poor credit or those who are desperate for cash, using aggressive sales tactics and deceptive terms. Once the homeowner takes on the additional debt, they may find themselves unable to keep up with the payments. As a result, they risk defaulting on the loan and losing their home to foreclosure. In this scenario, the lender profits from the high-interest payments or the foreclosure process, while the homeowner is left with little to no equity and, in many cases, without their home. 2. Foreclosure Rescue Scams. Another common form of predatory equity stripping is the foreclosure rescue scam. In this scheme, a scammer approaches a homeowner facing foreclosure and offers to rescue them by arranging a sale or transfer of the property to a third party, often under the pretense of allowing the homeowner to stay in the home as a renter with the option to buy it back later. However, the terms of these arrangements are typically unfavorable to the homeowner. The scammer may charge exorbitant fees, structure the deal in a way that makes it impossible for the homeowner to repurchase the property, or simply take the title and disappear. In many cases, the homeowner ends up losing the home and any remaining equity, while still being responsible for the original mortgage debt. Legal and financial implications of equity stripping. Equity stripping, particularly when used in predatory practices, can have severe legal and financial consequences for homeowners. Understanding these implications is crucial for protecting one's assets and financial well-being. 1. Loss of homeownership. The most significant risk associated with predatory equity stripping is the loss of homeownership. Homeowners who fall victim to these schemes often find themselves facing foreclosure or eviction, losing both their home and the equity they had built up over the years. This loss can be devastating, particularly for individuals who have invested significant time and money into their property. 2. Damage to credit. When a homeowner defaults on a loan or faces foreclosure, their credit score takes a substantial hit. This damage can make it difficult for them to obtain future loans, rent an apartment, or even secure certain types of employment. The financial fallout from predatory equity stripping can thus have long-lasting effects on a person's financial health. 3. Legal repercussions. Homeowners who engage in or fall victim to fraudulent equity stripping practices may also face legal repercussions. For instance, if a homeowner knowingly participates in a scheme that defrauds lenders or other parties, they could be held legally accountable. Conversely, homeowners who are defrauded may need to engage in lengthy and costly legal battles to try to reclaim their property or seek damages. Protecting against predatory equity stripping. Given the potential risks associated with equity stripping, it is essential for homeowners to take proactive steps to protect themselves. 1. Be cautious with loans and refinancing. Homeowners should be wary of taking on additional debt against their property, especially if the terms seem too good to be true or if the lender is using high-pressure tactics. It is crucial to fully understand the terms of any loan or refinancing agreement and to seek independent financial advice if needed. 2. Avoid foreclosure rescue scams. If facing foreclosure, homeowners should be extremely cautious of unsolicited offers of help. Legitimate foreclosure assistance is often available through government programs, nonprofit organizations, or reputable legal professionals. Homeowners should thoroughly research any company or individual offering foreclosure assistance and be wary of any arrangement that involves signing over the title to their home. 3. Consult legal and financial professionals. Before engaging in any equity stripping strategy, whether for asset protection, tax planning, or investment purposes, it is advisable to consult with a qualified attorney or financial advisor. These professionals can help assess the risks and benefits of the strategy and ensure that it is executed in a way that is both legal and financially sound. Equity stripping is a complex financial strategy with both legitimate and predatory applications. While it can be used for asset protection, tax planning, or investment purposes, it also carries significant risks, particularly when used by predatory lenders or scammers. Homeowners must be vigilant and informed to protect their equity and financial well-being. By understanding the various forms of equity stripping and taking appropriate precautions, individuals can safeguard their most valuable asset, their home, against potential exploitation. Thanks for watching. Please subscribe.